So welcome back to Financial Accounting. This little mini lecture reviews the in-class exercises from Chapter 5. So we got to prepare necessary journal entries for this Magic Carpet Company to record transactions. These all have to do with purchases and payment. And this is a perpetual inventory system. So remember, under perpetual inventory system, every time we make a purchase, we got to increase the inventory. Every time we make every time we have any type of return, we have to adjust the inventory, got to reduce it. And when we actually pay bills for merchandise purchased on account, if we pay less than the list price, we also have to reduce the inventory by the amount of the discount that we take. So with that background, let's take a look at each of these transactions. So it's perpetual. So you purchase $49,000 worth of merchandise on account. So that's transaction A. In a perpetual system, when you purchase merchandise on account, the account you debit is inventory, and you purchase it on account. So it's a debit to inventory and a credit to accounts payable. Don't mean to sound like a broken record here, but some of you still struggle with journal entries. Make sure when you do the journal entry, you show the debit first, followed by the credit. And be sure that when you record the entry, you apply the rules of debits and credits. So ask yourself, if I got to increase inventory, what kind of account? It's inventory. It's an asset account. So you debit it, and you purchase the inventory on account. And when you purchase stuff on account, you have to recognize accounts payable and increase the balance of a liability account. You have to credit it. So that's A, purchase $49,000 on account, terms 210 net 30, which means if we pay it within 10 days, we're entitled to take a 2% discount. So we don't have to pay the full amount, but we have to pay the full amount within 30 days. B, return $4,000 worth of damaged merchandise for credit. So here we're returning merchandise that we had previously purchased. So, and we're returning it to get credit, which means we're going to reduce the amount that we owe the company. So to reduce the liability, you're going to debit accounts payable. And anytime you, in a perpetual system, anytime you adjust inventory, you've got to record a journal entry to show the change in inventory. So a $4,000 return of inventory would be a debit to accounts payable and a credit to inventory. And then in C, paid the merchandise purchased, paid for it, paid it within 10 days. So you're entitled to take a 2% discount if you pay within 10 days. So you're not going to pay the full amount due. And the full amount due is not $49,000. Remember, you had a purchase return of $4,000. So accounts payable of $49 reduced by 4 means that you owed $45,000, not $49,000. And you're not going to pay the full amount. You're going to take a 2% discount because you paid within the discount period. 2% of $45,000 gives you the $900. So the amount that you're actually going to have to pay is not $45,000, it's $44,100. The $900 discount actually reduced the cost of the inventory. So under a perpetual system, when you have a purchase discount, you actually reduce the amount of the inventory. Right? So there's your 3 transactions. Exercise 2. Charlie Company uses a perpetual system during May. The following transactions and events occurred. So here we're not dealing with the purchase. Here we're dealing with the sale of inventory under a perpetual inventory system. So remember, under perpetual inventory system, every time we have a purchase, we know that we have to increase the inventory. Every time we have a sale, in addition to recording the sales revenue, I've got to record the reduction in the inventory. And every time we have a sales return, you're going to have to adjust the inventory as well. So let's take a look at the 3 transactions here. On May 13th, sold eight motors at $45. Terms 410 net 30. So if they pay within 10 days, they're entitled to take a 4% discount. Let's be very anxious to get our cash. We're giving them a 4% discount. The full amount is due within 30 days, and the motors cost us $26. So May 13th, we've actually got 2 transactions. We got to record the sale, and it's a sale on account. And if you're going to record a sale on account, you have to debit accounts receivable. So that's $45 is the sales price times 8 units. That gives you $360. And the sales revenue is also $360. So that's 1 transaction. So I record the sales revenue based on the sales price. I sold 8 units. But at the same time, since it's a perpetual inventory system, you also have to record the cost of the sale. So the units cost us $26. So this is where we get our markup. We're buying them in large quantity. We're paying $26 a unit. We're turning around and selling them at 45. So that'll give us a profit on each sale. So our cost is $26 a unit times 8 units. So you got a debit to cost of goods sold and a credit to inventory. So under perpetual system, you record the sale. You also record the cost of goods sold. May 16th, one defective motor was returned to Charlie's. Now, when you have a sales return, we don't reduce sales. We have what we call a contra revenue account called sales discount. So contra revenue is a revenue account with a debit balance. So we've got sales returns and allowances, 1 unit for $45. So we debit sales returns and allowances. We credit accounts receivable. And now that this unit has been returned, we got to put it back in inventory. So we debit inventory and we credit cost of goods sold. Again, not to sound like a broken record, under the perpetual inventory system, every time you have a sale, you've got to record not only the sale, you got to record the cost of the sale. Every time you have a sales return, you not only got to record the sales return and the reduction of accounts receivable, you've also got to record the stuff coming back in the inventory. And on May 23rd, received payment in full from Scruffy Brothers, round to the nearest dollars. So they originally owed us $360, but there was a $45 return. So the amount that they owed us was $315, but we're not going to get the full amount. Since they pay within the discount period, they're entitled to take a 4% discount. So if you multiply $315 times 4%, you get a sales discount of $13. That's another contra revenue account. So like sales returns and allowances has a debit balance, sales discounts will have a debit balance too. And your amount of cash received is the full amount that is owed minus the discount. So we're only going to get $302. So please be prepared to do the entries for both the purchase of the inventory and the sale of the inventory, and the purchase return and the sales return. Third one here, we got to do a little mini multiple step income statement. So multiple step income statement, what we need to do, if it's a merchandiser, we're going to have to show the sales and the net sales, which means we'd have normally take gross sales and have to reduce that by sales returns and allowances and sales discounts. But here they made it simple for us. They just did net sales. So it's going to be net sales minus cost of goods sold. That's going to give us something called gross profit. From that, we're going to subtract out the operating expenses and get operating income. And then we have to consider other items of revenue, other items of expense, and put those in a separate section after income from operations. Here's my Wayne Gretzky scoring a goal analogy. Again, I said Gretzky was a great goal scorer because when he shot the puck, he had a mental picture of the puck going into the net. So when you're asked to do a multiple step income statement, get a mental picture of what it's going to look like before you attempt to do it. So we know we're going to have sales. We know we're going to have to subtract out cost of goods sold. That's going to give us gross profit. That's going to give us income from operations. Then we got to consider the other items of revenue and expense, and then we'll get net income. So drawing upon this information here, whenever you do your income statement, you got to put the name of the company. This is a little typo. This should be over the income statement here. So Bolivia Company income statement for the year ended. Income statement is for a period of time. This happens to be for a year. And here's why we call it multiple step. Sales minus cost of goods sold gives us gross profit. Subtract out the operating expenses. That gives us income from operations. Then we have to consider other items of revenue and other items of expense and losses. So do the revenue first. So dividend revenue is not directly related. It's revenue that we received as a result of owning stock in other companies, but it's not directly related to the sale of merchandise. So that's why we put it below income from operations. And these expenses we have here, casualty loss from vandalism and interest expense, those are indeed additional expenses and losses that are independent, not directly related to operations. So you take the income from operations, get the subtotal there of the revenues and the additional expenses and losses, and you end up with net income of $235. So don't be surprised if next exam, I'll ask you to prepare a multiple step income statement. Use this one as a model. The last one, we've got a periodic system. So periodic system is different than perpetual. Periodic system, you don't know what's in inventory. The only time you know what's in inventory is when you physically count it. And when you purchase inventory, you're going to debit an account called purchases. And when you have purchases discounts, you're going to call it purchases discounts. So the accounts that you're going to use are going to be different than when you use under a perpetual system. So we're going to be, rather than debiting inventory for a purchase, you're going to debit something called purchases. So let's take a look here. Purchase 10 motors at $42. Terms 410 at 30. The motors cost Thompson Company $25. Okay. So to record the purchase, it's 10 units times 42. There's my 420, and a credit to accounts payable. So notice under the perpetual system, I'm not debiting inventory. I'm debiting an account called purchases. May 16th, return one defective motor. So one motor that I'm returning, I paid $42. So I'm going to debit accounts payable because the amount that I owe the vendor now is going to be reduced by the cost of one motor. And we're not going to put it in purchases. We're going to have a special account called purchases, returns, and allowances, which is the account that I use to show that any purchase that was returned. And then on May 23rd, paid Thompson in full, round to the nearest dollars. Well, I owed him originally $420, but then I had a $42 return. So I actually owe them not $420, but I actually owe them $378. So I'm going to be debiting $378, but I'm not going to pay them $378. I'm entitled to take a 4% discount. 4% of $378 is $15. The difference between the $378 and the $15 is the amount of cash that I actually have to remit. Okay. So I hope you found that little review useful, and we'll be doing this going forward from here on in. We'll do them in class, and then I will not only give you the solution after we do them in class, I'll do a little video review. These questions are the types of things that tend to show up on exams as well, so it's good practice for your second exam. All right, everybody. Adios. Hasta luego. See you soon.